Hey, what's going on, guys? Going to make a quick video showing you how you can sell covered calls on the Robinhood platform. This is QQQ. It's a very liquid ETF that I like to sell options on. But for this example, let's just go ahead and select the expiration date um, of December 20th. So it's roughly 36 days away. And that is a monthly contract. So there's going to be more option volume with that. Currently the QQQ is trading around 506.76. So to purchase 100 shares of QQQ, it's going to cost over $50,000, almost $51,000 there. This is assuming you have 100 shares of QQQ. But the cool thing about the stock market is there are tons of different stocks, ETFs that you can pretty much implement this strategy on too. In order to sell the covered call, we're going to assume you have 100 shares. And then the next thing you want to do is just make sure this is on the sell side and the call side right there. This is kind of the challenging part, being able to select the correct expiration date as well as the strike price. So pretty much what we're doing as a seller of covered calls is we're saying that, hey, we are selling our rights away at this strike price, right? So 515. So let's use that. Well, that's a little bit. Let's go a little bit more conservative, closer to a 20 delta, or 82% chance of profit. I don't like the 78. So let's just sell the 530 here. Let's assume we want to sell this. So it's roughly a week out. It's going for 272 currently. Was a huge red day in the market, down 1.07%. So this option premium has dropped a good bit. So typically I like to try to sell these on green days because that means the option premium is going to be higher. But needless to say, what this means is we're selling our rights away to these shares at 530. So pretty much it's like selling a limit order at 530. And anything above that we're missing out on. The cool thing about this, so our break even is going to be 532.72. And that's calculated because you have a 530 strike price plus 272 worth of premium. So hope that makes sense there. But yeah, so this is it's an income strategy, right? Like obviously if you're a growth investor, covered calls might not make the most sense for you. But if you're looking for income or if you're looking to create additional yield from your portfolio, this could be a strategy you could look at. Definitely want you to be comfortable with it, do your own research, make sure you understand the risk of options. But this could be a tool set you could have in your tool set that you can implement, right? Covered calls can be very, very great if you're willing to sell your shares away. Obviously, I got a little carried away a couple weeks ago with Tesla. I sold some covered calls that the stock just blew up after the election. It just shot up. So I had some shares got caught away, but it was a leveraged version of Tesla, so I was okay with that. I didn't end up rolling it or anything like that, but just kind of it's something that's you're gonna have to play around with. It's gonna be hard to predict every single expiration and strike price. Sometimes you're just gonna not uh, choose the correct expiration or strike, and sometimes you'll have to roll. So that's another strategy. You know that we can talk about later, but this is just kind of implementing just this basic of selling that covered call. You have to have 100 shares, and then you have to obviously be approved for options. So looking at the Greeks here, the big ones that I like to look at is delta, and delta is pretty much your chance of profit, pretty much, if that makes sense. So we have a 82.91% chance that this option will expire worthless, or a 21 delta. So delta starts at 1. So you can kind of see how those correlate there. Theta is how much this contract is projected to decay every single day towards as we get closer to expiration, this is going to increase. So this option is made up of implied volatility and then extrinsic value as far as time decay. So that kind of is what makes that up. So it's, yeah. And then gamma is For every dollar movement, it's going to change delta. So if QQQ jumps up $10, it's going to roughly move the delta up to 30-ish. But just keep in mind, these numbers move really quickly. So, if there's any big movement, these numbers can change very quickly. But yeah, so that is that. Once again, this is an out of the money covered call because it is not in the money. If it was in the money, it would be pretty much any of these strikes are in the money because it's the current ETF is above the current strike. Hopefully that makes sense. But yeah, that's a very high level illustration of selling covered calls. It works great in some markets and sometimes it doesn't. Obviously, if markets are shooting straight up, it may not make a whole lot of sense to be selling covered calls because you're just capping your gains on the upside. However, if we're in a bear market, it could be a great way to hedge the downside. They can be a little tricky. The market could pull back and then you sell a covered call, but then it shoots back up. So there's definitely some skill that goes into mastering this strategy. Pretty much with all strategies out there, there's a high level way to kind of analyze it. But then if you want to get really good at it, you gotta fine tune it. You gotta test it, and then kind of figure out, what makes the most sense for you. Once again, this is selling a 20 delta. A lot of people imagine this is kind of the higher end. They want to sell a little bit more conservative. So you can see the farther away we go from this 506 number, our chance of profit is increasing. However, the premium is decreasing. So just keep that in mind. But you are going to be making more money on the the total break even. So just if you want more upside, sell further out of the money contracts. So this is 11 delta. We'll be selling our shares away for 541.22 pretty much because that's a 540 strike plus $1.22 of premium there. And do just keep in mind that these are multiplied by 100. So it'll say $1.22, but you just multiply that pretty much by 100 there. Okay. Whereas this is 81 cents is equivalent to $80 of premium there. So yeah, guys, that's going to be it for today's video. Very high level introductory video on how to sell covered calls. But I definitely recommend if you're interested in the strategy, first of all, make a decision before ever entering it that you're willing to sell your shares away at X price. So typically you definitely want to do it above your cost basis. So if your cost basis is, in this instance, 550, you probably don't want to be selling a 515 covered call unless your adjusted basis after several months of selling premium has dropped a significant amount. Then that can make sense as well. But typically, if a part of the wheel strategy, if someone gets assigned at 525, then they're going to sell calls at 525 or above it. Sometimes I sell it below my cost basis, but I do account for the premium. So you can see if we got assigned at 525, that we could still sell a 520 call and make $62 because our break even is 525.62, and that's because of this premium being so high there. So hope that makes sense. Please like and subscribe down below.